Welcome to the deep dive. We're really thrilled to have you here with us today because our mission is to unpack a truly massive, incredibly diverse stack of sources you've shared with us. We're looking at um, deep macroeconomic research from Elizinents, breaking financial news from Guru Focus and Intellectia.ai, some corporate strategy analysis from The Motley Fool, and a really fascinating fact check from
Oh
Snopes.
yeah, it is a remarkable mix of information. We are going to connect dots across these sources that, you might not even realize belong on the same canvas. We're taking you from the front lines of global conflict right down to the inner workings of corporate boardrooms.
To do that properly, we really need to paint a clear picture of the world right now in March 2026. The globe is reeling from a sudden, massive geopolitical shock. Following failed nuclear negotiations, the United States and Israel have launched direct military strikes on Iran. This single flashpoint in the Middle East is already cascading through, well, global shipping lanes, inflation metrics, corporate strategy, and even internet prediction markets.
The ripple effects are moving at breakneck speed. They're hitting sectors and reshaping economies in ways that require a real understanding of the underlying mechanics to fully grasp.
Right. But before we jump into those mechanics, I need to state something very clearly to you, our listener. Because our source material covers highly sensitive, politically charged actions involving the US, Israel, Iran, and the Trump administration, we are remaining strictly impartial. We are not taking any sides or endorsing any political viewpoints.
Exactly. We are strictly analytical here.
We are simply reporting the facts and the ideas contained in the original source material to help you understand the global impact. We are not endorsing any military actions or administration policies.
Our focus is entirely on helping you navigate the information and understand the incentives driving these massive global shifts.
And there's a lot to navigate today. We're going to show you how a military strike in the Middle East relates to Exxon's drilling plans in South America, why Netflix is suddenly thrilled to walk away from a $100 billion mega merger, and how crypto bettors somehow magically predicted the exact timing of a geopolitical crisis. Okay, let's unpack this.
Right, the triggering event.
Yeah, according to the deep macro report from Allianz, the U.S. and Israel struck key military and civilian infrastructure targets in Iran. These strikes resulted in the deaths of Supreme Leader Ayatollah Ali Khamenei and multiple senior officials in the Islamic Revolutionary Guard Corps. The U.S. has officially declared major combat operations.
And this is what economists call a nonlinear geopolitical shock. The consequences don't follow a simple, predictable path. But the most critical transmission channel for this shock to reach the rest of the world and to reach your everyday life is the Strait of Hormuz.
The ultimate choke point.
The ultimate choke point. Roughly 20 million barrels of crude oil and 30% of global seaborne hydrocarbons transit through this strait every single day. It is literally the jugular vein of the global energy market.
And the immediate paralysis described in the sources is just staggering. Crossings through the strait have plummeted by over 70% almost instantly. Major shipping lines are just halting operations completely.
They can't risk it.
No, they can't. Right now, there are more than 200 oil and LNG vessels just sitting there, anchored right outside the strait. They are completely paralyzed. War risk insurance has spiked so high it's economically unviable to move, and commercial vessels are receiving VHF radio warnings directly from the Iranian Revolutionary Guards telling them not to cross.
And you have to think about the mechanics of that paralysis. It's not just about gas prices at the pump for you. Ocean freight makes up about 2 to 3% of the final retail price for manufactured goods.
So it hits everything.
It hits everything. When 200 massive cargo and energy ships are blocked from moving, or when they're forced to take massive multi-week detours around the Horn of Africa, fueling costs skyrocket. A 40 to 50% increase in fueling and insurance costs for these maritime giants translates directly to higher freight costs, which eventually means higher prices for goods at your local store. The friction in the supply chain is immediate.
That brings us to the immediate market reaction. The Intellectia and Guru Focus sources show that Brent crude oil surged over 7% in a single day. To put that in perspective, that is 3 times the jump we saw on the day Russia invaded Ukraine back in 2022. Oil spiked to around $82 a barrel right out of the gate. And it's not just oil.
No, we are seeing immediate structural shifts in the natural gas markets as well. Qatar, which relies heavily on the Strait of Hormuz to export its energy, had to completely halt its liquefied natural gas output. Yeah, that puts 20% of global LNG flows at risk overnight. But the global economy abhors a vacuum. While Qatar is forced to pause, U.S. exporters like Cheniere Energy are rapidly swooping in, redirecting their fleets to capitalize on the spiking global gas prices and fill that European demand.
It's a massive scramble. So, where does this go from here? The Alliance report outlines three potential paths or scenarios for this conflict. Walk us through those projections.
Sure, the first is their baseline scenario, which they consider the highest probability. In this path, the major military exchange lasts less than 4 weeks. The U.S. and Iran reach some sort of rapid de-escalation deal, a new regime forms in Iran, and the Strait of Hormuz is only blocked for a couple of weeks.
So, a quick resolution.
Right. In this scenario, oil peaks around $85 a barrel and then actually settles back down to a normalized $70 by the end of 2026. The macro impact here is relatively contained, and the global economy absorbs the blow with a negligible impact on inflation.
So, a sharp, terrifying shock, but a quick recovery. What happens if the de escalation fails?
That leads to the second scenario, prolonged conflict. Here, the war lasts for months. There's no smooth transition of power in Iran, and the Strait of Hormuz is disrupted for a much longer period. Under these conditions, the friction becomes permanent. Oil hits $100 a barrel and stays elevated, creating a sustained drag on global growth. And the third scenario, the worst case. The third is the tail risk scenario. It's a lower probability, but a catastrophic impact event. The war escalates into a massive regional conflict. Energy infrastructure across the entire Middle East is severely attacked and destroyed, taking millions of barrels of production capacity offline permanently.
Oh, man.
Yeah. The Strait of Hormuz essentially has to be secured permanently by the U.S. Navy just to get a fraction of the traffic through. In this nightmare scenario, oil spikes to $130 a barrel, and global equities crash by 20%.
That is brutal.
If we connect this to the bigger picture, it fundamentally alters the entire macroeconomic landscape, specifically regarding inflation. Let's look at that prolonged conflict scenario where oil stays high. That alone could push overall global inflation up by half a percentage point.
Which sounds like a tiny fraction, but for central banks that have spent years fighting to get inflation down to 2%, half a point is a massive red flag.
The real danger there is that inflation in the U.S. has already been incredibly stubborn. An oil shock forces the Federal Reserve's hand. Alliance projects that this sustained inflation could force the Fed to abandon its highly anticipated plans to cut interest rates and instead hold them elevated at 3.75% for the foreseeable future.
Making borrowing more expensive for everyone, from homebuyers to corporate giants. And there's a specific hidden risk mentioned in the report involving the new Fed chair, Kevin Warsh. I was reading through the Alliance research, and they highlight a potential global liquidity freeze. Can you break down the mechanics of how an oil spike causes a liquidity crisis?
This is a vital piece of global financial plumbing that rarely gets discussed. When oil prices soar and stay high, European banks and primary dealers desperately need U.S. dollars because global oil is traded in dollars. They have to scramble to buy this newly expensive energy.
Right.
Usually when there's a dollar shortage abroad, the Federal Reserve steps in and extends what are called swap lines, basically emergency short-term dollar loans between central banks to keep the system lubricated. We saw this save the system during the March 2020 COVID crash.
But the research suggests Kevin Warsh might play this differently.
That is the crucial variable. Alliance notes that Fed Chair Kevin Warsh operates with a different philosophy and might be far more reluctant to extend the Fed's balance sheet to bail out international markets. If he refuses to open those swap line taps, those foreign banks literally run out of dollars. They can't fund their operations, credit freezes up, and a regional war in the Middle East suddenly triggers a severe global liquidity freeze.
Impacting businesses that have absolutely nothing to do with oil. Here's where it gets really interesting, though. In the middle of all this macro panic and potential liquidity freezing, some sectors are absolutely raking it in. We are seeing clear winners and losers. Defense stocks, as you might expect, are soaring. South Korea's Hanwha Aerospace jumped 20% in a single day, and LI Next One went up 30%.
Private markets are seeing massive tectonic shifts as well. Infrastructure private equity is suddenly positioned as a huge winner. As energy security becomes a panic-driven priority worldwide, sovereign wealth funds and institutional capital are flooding into local LNG terminals, domestic pipelines, and independent power grids.
Because they want to secure their own energy.
Exactly. They're projecting plus 10% returns in this sector, even if the conflict drags on, because the fear of reliance on the Middle East has permanently shifted the investment thesis.
Meanwhile, airlines and chemical companies are taking a massive hit as their two biggest expenses, jet fuel and petroleum feedstocks, skyrocket. But let's look at one specific corporate player that caught my eye in the Intellectual sources, ExxonMobil. They point out a fascinating paradox. Global oil prices surged nearly 30% overall on the news, but Exxon's stock actually dipped initially.
Yeah.
They didn't see the massive rally you would automatically expect for an oil titan during a Middle East crisis.
On the surface, it looks like a mispricing, but it makes perfect sense when you analyze their underlying corporate strategy. Exxon isn't just reacting to daily spot prices of crude. They're playing a very long, highly diversified game.
The sources say they are preparing to send a technical team back to Venezuela, which seems like a massive pivot given the geopolitical climate there.
And the key to understanding that pivot is the technology. Exxon operated in Venezuela back in 2007, but since they left, they haven't just been sitting on their hands. They have developed highly advanced proprietary technology for extracting and processing heavy oil. They are now leveraging this new tech to re-enter a massive market with drastically better efficiency than they had 2 decades ago.
So they're actively choosing to untangle themselves from the volatility of the Strait of Hormuz. By diversifying their assets globally, pushing heavy capital into places like Venezuela and their massive offshore projects in South America, they create a buffer. They aren't solely reliant on the Middle East for their production growth.
It shows you how massive corporations build operational resilience to maneuver around these unpredictable geopolitical shocks. They are structurally insulating themselves. They're managing risk on a decadal scale rather than a daily one.
Speaking of managing risk, I want to pivot to something that feels like a storyline pulled straight out of a sci-fi novel. We have traditional markets reacting, infrastructure, capital shifting, and then we have the wild card, Polymarket. Both of these stories are fundamentally about risk assessment, but they are playing out in wildly different arenas.
The crypto casino, prediction markets. This adds an entirely new, almost surreal dimension to how the world processes and prices geopolitical events in real time.
I was reading the Snopes fact-check source, and the amount of money flowing into Polymarket right before the strike is staggering. It wasn't just a few bucks here and there from casual observers.
Far from it. The sheer volume of capital is unprecedented for a geopolitical event. Bettors on Polymarket had wagered over $500 million on exactly when the U.S. would strike Iran. $500 million sitting in a decentralized betting pool.
But it's the timing of the winning bets that is setting the internet on fire. Snopes confirmed that 6 brand-new, freshly funded accounts walked away with a combined $1.2 million. And they did this by betting heavily that the U.S. would strike specifically on February 28th, placing these massive wagers just hours before the missiles actually launched.
Yeah, the timing is wild. And there was one specific account too, right?
Oh yeah, an account called Magami Man. This single account made $431,000 predicting the exact strike date, and then pulled in another $143,000 betting on Common Eye being ousted.
This raises an important question, and it's one that is currently causing immense outrage and sparking severe allegations of insider trading across financial media.
Yeah.
People are openly wondering if federal personnel, military officials, or individuals with classified knowledge from the Trump administration are using these decentralized, largely anonymous platforms to cash in on highly classified military operations.
And here we must pause and reiterate our absolute impartiality rule for you, the listener. The Snopes report explicitly stated that they could not verify if these specific bettors had any inside knowledge.
Right, that's crucial.
They could not verify any connection to the Trump administration or the military. We are not saying insider trading occurred, and we are not endorsing the allegations or taking any political stance. We are presenting this purely as a verified, documented phenomenon that happened on the blockchain.
It is vital to separate the verified blockchain transactions, the actual movement of the money, from the unverified rumors of how those specific account holders knew to place those bets. What is undeniable, however, is the structural shift. Prediction markets are now highly liquid arenas reacting to and profiting from global conflicts in real time.
It's an incredible intersection where real-world geopolitics meets decentralized gambling. But as fascinating as that risk trading is, if we look at traditional media titans, we are seeing the exact opposite strategy. aggressively avoiding risk. Case in point from the Motley Fool Netflix. They have officially walked away from a massive $111 billion mega merger to acquire Warner Bros. Discovery, ultimately losing the deal to Paramount.
And yet, if you look at the market reaction, Netflix investors are absolutely thrilled.
The stock jumped 9% on the news that they lost the deal. Walk us through the incentives there. Why is Wall Street rewarding them for walking away from a studio empire?
Because sometimes the most profitable deal is the one you have the discipline not to make. Netflix is already the dominant streaming player globally. By walking away, they avoid absorbing Warner Bros. Discovery's staggering $33.5 billion debt load.
That is a massive number.
That debt alone would have been a massive anchor on Netflix's balance sheet, drastically reducing their ability to invest in new, original content.
Not to mention the regulatory nightmare. The Trump administration had already expressed severe skepticism about allowing a media monopoly of that size to form. If Netflix had pushed forward and regulators ultimately blocked the deal, Netflix would have been on the hook to pay a $5.8 billion breakup penalty.
Instead, because Warner Bros. Backed out of the final negotiations to go with the Paramount offer, the contractual incentives fought entirely. Netflix actually gets to collect a $2.8 billion termination fee.
Netflix essentially got paid nearly $3 billion to not buy a deeply indebted company. I'd love to fail that successfully. Plus, history tells us these massive media mergers, like the infamous AOL-Time Warner deal, often turn into disastrous money pits born of corporate hubris rather than sound strategy.
Netflix keeps its clean balance sheet, completely avoids years of grueling government antitrust scrutiny, gets a massive cash injection, and lets its rivals burden themselves with the gargantuan task of integrating two massive legacy corporate structures. It is a masterclass in strategic restraint and understanding your own leverage.
It really is. And just to show you how broad the market activity is right now and how different companies are handling various types of micro and macro risks, let's look at a few other grounding details from our sources. For instance, you have Target beating Wall Street's earnings estimates and projecting solid growth for 2026, which is a massive signal about the resilience of the everyday consumer despite these global shocks.
And on the corporate governance side, we saw Toyota finally yield in a massive $38 billion fight with the activist investor group Elliott. This shows that even legacy giants in Japan are being forced to restructure and unlock shareholder value when pressured by aggressive, well-funded activist mechanics.
We also saw Ziff Davis successfully offloading its digital assets, selling them to Accenture for a cool $1.2 billion in cash. It's a reminder that strategic acquisitions in the tech consulting space are still plowing ahead regardless of what's happening in the Strait of Hormuz.
And then you have the physical, operational hazards that run parallel to all this financial maneuvering.
Right. Adding to the sheer chaos of 2026, a United Airlines Boeing 787-9 suffered an engine fire shortly after takeoff from LAX. Over 250 people had to be evacuated on the tarmac. Thankfully, everyone was safe, but it adds to a string of severe airline emergencies this year. It's a stark reminder that while executives are trading billions on screens, operational resilience in the physical world is just as critical.
Absolutely.
So what does this all mean? We've covered an incredibly dense web of connections today. We've explored the mechanics of how a military strike in the Middle East immediately paralyzes 200 cargo ships, which threatens to spike inflation at your local store, which could ultimately force the Federal Reserve to keep interest rates high and trigger a global liquidity freeze.
It all connects.
We've watched Exxon structurally insulate itself from a 30% oil spike to focus on deep tech heavy oil extraction in Venezuela. We've seen crypto bettors mint millions of dollars predicting missile strikes, all while titans like Netflix navigate multi-billion-dollar chess games, ultimately getting paid billions just for walking away from the table.
You've been armed today with a truly comprehensive, multidimensional understanding of the current global landscape. This goes far beyond standard news headlines. You are seeing the hidden plumbing of the global economy, understanding the profound incentives behind how logistics, energy, corporate strategy, and even decentralized finance are intricately wired together.
It is a lot to process, but that is the real value of a deep dive. You aren't just hearing the news, you are understanding the mechanics and the motives behind it.
And as we wrap up, I want to leave you with a thought that builds on what we've discussed, particularly regarding those prediction markets. With platforms like Polymarket now handling hundreds of millions of dollars on the highly specific outcomes of geopolitical conflicts, we really have to wonder, At what point does the betting pool become so incredibly massive and the potential payout so lucrative that it stops just predicting global conflicts and starts actively incentivizing bad actors to create those conflicts just to win a bet?
That is a chilling thought regarding the future of risk and reward, and definitely something to keep an eye on as these decentralized platforms continue to grow. Thank you so much for joining us on this journey today. Keep questioning the connections and incentives in the world around you. Stay curious, and we will see you on the next deep dive.